Every generation believes it's smarter than the last until it loses everything the same way. That's the quiet truth of financial history. We don't invent new mistakes. We just update the software. Every bubble, from tulips to tech stocks, begins with the same illusion, that this time things are different. But they never are. The only real difference lies in the story people tell themselves before it all falls apart. In the 1600s, tulips weren't just flowers. They were symbols of status, collectibles before the blockchain ever existed. By 1637, a single bulb could sell for 10 times a craftsman's annual salary, and people were trading futures contracts on petals. When the music stopped, merchants, nobles, and farmers all went bankrupt over something they could have grown in their own backyard. A century later came the South Sea Company, the official sponsor of greed. Even the British government backed a corporation that promised infinite wealth through trade with South America, except it never traded anything. Still, everyone invested. Politicians, aristocrats, even Isaac Newton, the man who could calculate planetary motion but not human emotion. He lost most of his fortune in the crash and famously said, "I can calculate the movement of the stars, but not the madness of men," and that madness didn't stay in Britain. Across the channel, France was living its own fantasy, the Mississippi Bubble. A Scottish gambler named John Law convinced the French government to issue paper money and sell shares in a company that supposedly owned gold mines in Louisiana. It was a national dream built on propaganda and printed promises. When confidence collapsed, both the company and the currency imploded, destroying France's early experiment with paper money and sowing distrust for decades. 2 countries, 1 year, same story. The moment speculation goes viral, borders stop mattering. Fast forward to the 1920s. The radio was the internet of its time. Stocks doubled, tripled, even quadrupled. Banks lent money so people could buy more stocks, which raised prices further and created collateral for even more loans. It was a feedback loop of euphoria disguised as prosperity. And when the market crashed in 1929, it erased nearly half of America's industrial production in just 3 years. That's what happens when leverage meets illusion, when everyone borrows tomorrow as wealth to buy today as fantasy. Bubbles aren't about numbers. They're about belief. Each one starts with something real, a breakthrough, a new technology, a fresh frontier. But every one of them dies the same way, not because the idea was wrong, but because the story was too good. That's the anatomy of a bubble. Something exciting, something misunderstood, and something over-leveraged. It's part psychology, part economics, and mostly theater. And the scariest part is that you're living through one right now. The only question is whether you'll see it before it bursts. To understand how, you need to see the pattern, the rhythm of mania that repeats every generation. It always begins with innovation. The tulip was a mutation of nature, the South Sea Company was financial engineering, and both made greed look like vision. Then comes liquidity. Easy money, low interest rates, and cheap credit. The easier the cash, the faster belief spreads. And once prices start rising, innovation doesn't even matter anymore, momentum takes over. In the 1990s, the internet arrived and investors lost their minds in binary. Anything with "com" in the name doubled overnight. People quit their jobs to day trade. Venture capital poured gasoline on the mania. Analysts said profits didn't matter, eyeballs did. By 2000, the Nasdaq had tripled. A year later, it lost 80% of its value. The irony, the internet was revolutionary. It changed everything, just not at the prices people paid for it. Then came the housing bubble, the masterpiece of financial illusion. Everyone believed real estate could never fall. Risk was diversified, and even your barber thought home prices only went up. Underneath that optimism was a tower of debt, mortgage-backed securities, credit default swaps, synthetic CDOs, paper stacked on paper until no one knew what anything was worth. When it all collapsed in 2008, global GDP shrank by $4 trillion. Banks were bailed out. Homeowners weren't. Once again, history's favorite trick played out. Privatize the gains, socialize the losses. Here's the uncomfortable truth. Bubbles aren't just markets losing control. They are power structures refusing to. Every time the system breaks, those at the top rewrite the rules so it won't break for them next time. Central banks cut rates, governments hand out bailouts, and everyone swears lessons were learned. But the only lesson the elite truly learn is that risk pays, because someone else always cleans up the mess. Then came the bubble that wasn't supposed to be possible. Digital assets. Crypto began as rebellion, a decentralized alternative to the system that caused 2008, but once money flooded in, it turned into the same old game. ICOs replaced IPOs, tokens replaced tulips. The slogans were new: HODL, diamond hands, number go up. But the psychology was ancient. Then came NFTs, the purest speculative fever of all. A JPEG of a rock sold for over $1 million. A pixelated ape sold for $3. Twitter avatars became investment portfolios. People weren't buying art. They were buying membership in a fantasy. Collectors called themselves hodlers, short for hold on for dear life. Forums filled with memes about diamond hands and betrayal by selling. Every bubble has its language, and this was the dialect of digital faith. Then came the rug pulls. Projects vanished overnight. Insiders cashed out. Floor prices collapsed. Trading volume fell by 90%. NFTs turned out to be the South Sea bubble written in code. A reminder that you can mint scarcity out of abundance. But the lesson isn't just that greed repeats. It's that power learns. After every crash, the system evolves to make the next one bigger, faster, and harder to escape. Today, we don't even need tulips or JPEGs. The system itself is the bubble. Zero interest rate policies pumped cheap money into everything: stocks, housing, private equity, even art. The Federal Reserve printed nearly $9 trillion after 2008, and that liquidity had to go somewhere. It didn't go to you. It went into assets, driving up prices that made the rich richer and made everyone else feel rich too. Governments around the world kept the illusion alive with stimulus and credit. In 2021, U.S. household net worth jumped by $30 trillion even as wages barely moved. It felt like prosperity, but it was paper wealth dependent on near-zero rates and inflated valuations. When the Fed started tightening, the air hissed out fast. Stocks fell, housing slowed, crypto evaporated. For a moment, reality peeked through the cracks, and then we all went back to pretending again, because the bubble isn't just in markets. It's in expectations. We've built a global economy that depends on permanent optimism. Every pension fund, every startup, every government bond portfolio, all of it assumes growth that never stops. But nothing in nature compounds forever, and yet that's the lie holding the system together. The warning signs are flashing again. Corporate debt at record highs. Tech valuations near pre-crash levels, and private equity drowning in leverage. The AI boom echoes every bubble before it, a real technology wrapped in a trillion-dollar fantasy. History is whispering what comes next, but most of us are too busy chasing the next hype to listen. So how can you spot the next bubble before it pops? Look for 3 signs. When prices rise faster than comprehension. When experts insist you don't understand the new paradigm. And when your friends start getting rich doing nothing, that's when you're no longer investing, you're auditioning for a history book. The hard truth is that bubbles don't die because of math. They die when reality runs out of believers. If you want financial freedom, stop chasing the next mania. Learn to recognize the pattern, because the biggest bubble isn't Bitcoin, tech stocks, or real estate. It's the illusion that someone else will warn you before it bursts. History doesn't repeat, but it rhymes. And if you can hear the rhyme, you already know what comes next. If this gave you a new perspective, hit subscribe, because history has the answers, and I'll show you where to look.